Those of you that are joining us for the first time, Fratarcangeli Wealth Management has been in force for 30 years as of this December, where I started and began my career in the World Trade Center Tower 2 and as a trainee, going through all the exams and training back at my old firm called Dean Witter, those of you that remember. We are now comprised of 40 professionals, managing over 40 with a holistic, call it 360-degree view and vantage point for the clients that we represent and have the honor to be a part of, looking at not only their investments and their strategies that essentially are implemented for the near term, long term, and everywhere in between, goals that they have for their family, their legacy, and their business. But we also look at their tax side of the balance sheet and how they can be forward thinking in regards to planning, their estate planning for their legacy, as well as other aspects that are on their balance sheet, like expenses with their property casualty and healthcare, and many other categories that become more and more important on the financial picture for our clients that are comprised of families, individuals, entrepreneurs, businesses, and also athletes and entertainers, looking at the risks, the headwinds, the blind spots, and essentially all of the areas that are going to allow them to be most successful. And Fratarcangeli Wealth Management is attached to Wells Fargo as our custodian, as an independent practice. We leverage the platform available to us through the banking and Wells Fargo's. We also leverage all of the resources that I've been able to come across throughout my 30 years. And that ranges from analysts, frontline folks, and companies that we know very well that are experts in different areas that we can utilize to help make sure that we're fully prepared for all maybe coming or what we've learned from in the past. So we'll talk a little bit about that leverage in our guest here. But here we are today, as mentioned, facing a crossroad, and we've decided to bring in one of our partners that you've seen before, Bernard Koepp, who's the portfolio manager, managing director of C.J. Lawrence, one of the longest standing investment firms and analytical firms in the universe of investments, and someone that I've grown to really appreciate your opinion, Bernard, knowing that here we sit today with your expertise, not only here domestically, based in New York, but your involvement and connections in your early part of your career internationally, coming from Germany, kind of seeing all sides of the domestic and global markets and how things can evolve over time. And here we sit today, Bernard, we have the U.S. markets down roughly 10% compared to the international markets. The markets are hitting new highs, but yet we're underperforming the international markets by double digits. And we also have the dollar that has been under pressure, that is down roughly 10% year to date. And I'm very interested to hear what your take is to why that is happening. Will it persist? And how do we position ourselves in understanding what this current situation brings us and what we need to be looking at going forward? What says you?
Yeah, great. Thanks, Jeff, for having me back. I mean, look, it's been quite a year. You know, we had a massive drawdown in April, and then here we are at all-time highs in the market. So look, I mean, last time we spoke, Jeff, you know, remember we had a call, and I was quite bullish coming into the year, and it was really the fundamentals were setting up really nicely for U.S. equities, but also for, I mean, we spoke about international equities then. I mean, I think finally the international bug, so to speak, has been sparked, and a lot of that has to do with what's happened in what we call deglobalization. And it's really, you know, our president has gone on this policy where America is first. We're reshoring a lot of manufacturing. We're a lot of strategic manufacturing, everything from semiconductors to defense. And the same is really going for Europe. I mean, Europe has been kind of in a no-growth environment or for, you know, many years now. And of course, you know, the Ukraine war is something that's been weighing heavily on, especially on the German economy for the last couple of years. So all those things have come together around the March, April time, where the Europeans have decided, especially the Germans have decided, we're going to leverage up the German economy. And if you look at leverage ratios, I mean, our economy, I mean, we're the largest economy in the world. We have debt to GDP at around 100. So we're 100% leverage, but, you know, we're the reserve currency. We're the best economy in a sense in the world. The German economy was only 60% leveraged. So if you think about debt to GDP, and for the third largest economy in the world, 60% loan to value, if you want to call it, or the indebtedness to GDP is high from a German historical point of view, but it's of course not high compared to the United States. So what the Germans have done, and this is why European equities have gone up so much, is they've said, okay, we're going to get rid of the debt ceiling and we're going to leverage up 500 billion euros. And this is the new government in Germany run by Friedrich Merz, who's an ex-BlackRock guy. So he's a fellow Wall Street guy. He knows money. He's made money. He understands business much more than the previous government. So they've decided they're going to leverage up 500 billion euros over the next 10 years. And a lot of that money is going to flow into defense, aerospace and defense, and infrastructure and banking. Okay, so to speak. So all of these equities, especially in Europe, have gone up a huge amount. I mean, we run a domestic strategy, our Bulldog equity strategy, and an international strategy. The international strategy is up 35%. So of course, few people were positioned to really capitalize on that massive return. But I think in anybody's asset allocation at this point, international should be at least have a placeholder in high quality stocks. And most of that is Europe. So that would be Germany, France, and the UK. And there's some, international markets in Asia now as well have become quite investable. You see that in stocks like Alibaba, but also South America. So there's other international markets where the valuations were so depressed because nobody really cared. So these valuations are now relative to the U.S. market have gotten quite attractive. I mean, the dollar, just to address that, I mean, our dollar had been overvalued versus other currencies for decades. So I think what has happened in a very quick correction that was really basically in the April-March period, when our president announced the Liberation Day, which was basically using tariffs as a way to renegotiate our terms of trade around the world, that got our dollar down as well. So basically, this relative strength in the dollar, which was way overblown in the last, I would say, 5 to 10 years, and it really hurt our exports from the United States, that has been corrected pretty much in a very quick way. Can't hear you?
There we go. Sorry about that. Doing with fun technology. That being said,
yeah,
the fact that Liberation Day essentially kicking off the tariff negotiations, we saw a number of companies, folks that I deal directly with, really jumping ahead on their inventory needs and really creating more imports than maybe they would have otherwise. How much do you feel, Bernard, that has played into the dollar depreciating in addition to the fact that maybe it was just overdue?
Yeah, no, you're absolutely right. So we saw some pull forward in orders. I mean, a lot of that was on the chip side. If you remember, President Trump announced some massive tariffs on everything from chips to automobiles and all sorts of things. I mean, we now have a deal with the European Union on most goods, and they're still tweaking this in certain parts that are either in the defense industry, because if you remember, our defense industry has a lot of subcontractors that are actually in Europe as well. I mean, the Germans and the French and the Brits are actually quite good at aerospace and defense. So a lot of the parts that go into our jet fighter planes or into our ships and things are actually also subcontracted from Europe. So a lot of that pull forward that we saw was a bit of a panic buying. So we saw GDP in Q1 and Q2 a little bit higher, and we just revised Q2 GDP in the US up from 3 to 3.3%. So yes, there was a bit of a pull forward, but a lot of the anxiety about tariffs is kind of in the rear view mirror now. I mean, look, there's a court battle going on about the legality of tariffs, but the market does not think this is an issue, and I think the Supreme Court will deal with that. But going forward now into the final quarter of the year, yeah, I mean, the economy is slowing a bit, but we have a setup for the economy where it's almost like a Goldilocks type of economy. We have steady growth at about 3%. We have the Fed that will most likely cut rates. We have this bill that was passed, a big, beautiful bill, which had some amazing things in it for corporations, and accelerated depreciation is one of those. So all the investment that we read about for data centers and AI, that capex can now be depreciated on your balance sheet in the first year. So you're seeing not only pull forward in orders of things that we saw because of the tariffs, but we're seeing pull forward of investment for future growth. So that's the part that makes us quite bullish about the next couple of years, because we see companies not just in the technology space, but also in the reshoring space, and that's the industrial part of the economy, going full speed ahead, doing the reshoring of a manufacturing capacity that we've been waiting for years.
So the impact of the clarity of the beautiful bill that's been signed as of July 4th, and as well the benefits that we now can definitively understand are permanent, as well as the ability to write off 100% of spending. CapEx spending in the fourth quarter has always been a narrative that I've watched, heard, and studied as it relates to what are they going to see relative to corporate spending in the fourth quarter that could be beneficial to whatever it is they're trying to achieve, in this case, tax deductions, right? And
right.
So you're seeing that as a tailwind that we might not have actually felt in some of the numbers that we've read and
right,
are
and
seeing.
it boosts the cash flow. I mean, what the extraordinary thing with that is the cash flow position of the companies is improved right away, and that also feeds buybacks. I mean, a big portion of the earnings per share growth that we're seeing is also driven by buybacks. I mean, typically, if you think about a company, it has its capex, it has its dividend, and then the third thing is if there's any cash left, they typically buy back their own shares. And companies, especially technology companies like Apple, that generate massive amounts of cash, they buy back their shares. And that's one of the key drivers of this extraordinary earnings per share growth that we're seeing in the market. And there's all this hand wringing about, oh my God, the market is very expensive. But if we're looking at future growth in just the S&P 500, it's extraordinary. I mean, we've talked about this. I mean, I'm like a broken record, but when we talked about this at the beginning of the year, we talked about the fact it's very rare that you have 3 consecutive years of double-digit earnings growth in the forecast for the S&P 500. It's very rare. Only happens like it only happened like 4 times or 5 times since the Second World War. And if we look at the numbers, I mean, we're always looking at the numbers every day, and compared to when we last spoke, Jeff, the numbers have actually improved. I mean, there was all this, remember the hand wringing about the tariffs are going to be inflationary and create all this upheaval for profit margins. We haven't seen it. So the earnings estimates for the S&P 500 are next year's growth 13%, and now we're already seeing 2027 numbers, and those are expected to grow 13%. So the numbers, if we just show you the numbers, the S&P 500 today is trading at 6,400. The earnings are $266. So the market is trading around 24 times. Okay, that's not cheap. But then we use the forward earnings, which are about 300 for next year. Then we go to 21 times. And if we use 2027 earnings at about 340, we're at 19 times. And that, for an economy that's growing around 2 to 3% with inflation in check and the Fed cutting, is a great environment for equities.
I'm going to piggyback that, because the forecast for earnings growth has been double digits for 3 years. I'd like to talk about why you feel that's the case, technological advancements, productivity, efficiencies brought to us by this type of conversation, assuming my technology works, right? But the fact is, even though those earnings projections are very robust, we have to consider the fact that we're coming off the heels of Q2 earnings, where 81% of companies in the S&P beat their estimates, the highest number since Q3 of 2023. And furthermore, 340 companies out of 500 use the word tariff in their forecast. And then also the decline in the word recession by companies in the S&P 500 was down 87%. So you're starting to see a shift from the recessionary concerns, but you're still hearing about the tariffs, but yet the impact is at least for the quarter ending in 2 that we're now looking for 3, has been very optimistic. They beat their mark. So not only are we looking for a 13% earnings growth for 2026 and 2027, if you just look back to 2011, since we've been monitoring what companies have said they're going to do versus what they've delivered, 79% of the time they beat both top and bottom line. So the fact that we're trading 19 times 2027 earnings, and the fact that roughly 80% of companies have actually delivered better outcomes from that projection makes us pause and say, is the market really that frothy? Which leads to my next question. A direct correlation to what the market valuation price to earnings, and for those folks that are new to this, the more inflated valuations are, the higher the price divided by earnings per share. For those that want to compare to the history, we have averaged around 19 times earnings. Right. Today we're trading, as you pointed out, 21 times 2027 earnings. So a little lofty relative to history, but there's also another component that we monitor, and that is interest rates. Right. We know there's a lot of discussion, the word dissent by the Federal Reserve, that 2 members in plain English didn't agree with Jerome Powell's non-action. The fact that we're expecting rates on the short term to come down somewhere between 25 and 50 basis points in the next meeting coming up here in a week, not to mention 50 basis points for the year, a 95% probability. But what about the 10-year? Yeah. What about the 10-year? We're talking about the short-term rate coming down, but the 10-year around the globe, while we're one of the only developed nations that hasn't lowered interest rates this year, they've seen their 10-year rate go up. And the 10-year is something we look at, as you know, Bernard, yeah, and in correlation to the price to earnings ratio being less inflated or more inflated. There was an article I read recently that says, based on our current PE ratio, we need to have that 10-year down to around 3%. And today we're sitting at 4.2. What is your opinion on short-term rates and the impact that it has on our clients on the ground in manufacturing and other areas? And what do you anticipate that shorter term rate having an impact to the 10-year, and why isn't it being affected on the immediate action by the Federal Reserves in different parts of the world? I know a big question, but I know. No, I know, but
you got your finger on exactly the right thing. I mean, look, the Fed has been wrong here. I mean, the Fed has been late, and you know, we had to normalize the yield curve. The reason the European stocks and the international stocks are up so much is because the European Central Bank has normalized the yield curve in Europe. I mean, in Europe, you had negative interest rates as of just a year ago. So can you imagine being a bank? You know, a bank is in the business of taking deposits and lending the money out at higher interest rates. So you basically have that arbitrage or that spread that you earn on that yield curve that is like this, that is steep. So they've had an inverted yield curve with negative rates for years. And what the central bank in Europe has done, they've basically fixed that and gotten back to a normal shaped yield curve. And that's why the bank stocks are up, like stocks like Banco Santander or Deutsche Bank or whatever are up like 40% year to date, because the banks can finally earn a spread. The same is here in the US on a less extreme level. I mean, we've gone through this extraordinary period during the pandemic where we pumped liquidity into the market and it created inflation for sure. And you know, the Fed should have been lowering rates a lot sooner. We got 2 rate cuts last year, but we haven't had any follow through. And this, you know, this sort of conflict we're seeing between the Trump administration and Powell, it's a real one. But the data, where the problem with Jay Powell is he's looking at current data, and he should be much more anticipatory because we're seeing some weakness in the labor market already. So he's going to cut. So basically, that means we're going to have a more normal yield curve in the U.S. economy, which is also a predictor of better things to come. Typically, when you have a steepening yield curve, meaning the difference between 2-year and 10-year, that becomes bigger. It forecasts a better economy ahead, and we're going to see that. The problem we've seen in the yield curve is more on the 30-year side. It's very interesting, very, very long-term interest rates, and that's where there's been some, if you watch Bloomberg or CNBC or Fox Business, there's been some hand-wringing about, oh my God, 30-year rates are going up above near 5% now. That's fine because, I mean, the key thing is 10-year, as you said, Jeff. The key rate is the 10-year because that's where mortgages are priced off of. So if the Fed starts lowering rates, which we anticipate now in September at the September meeting, the whole yield curve will come down and we will see relief on the mortgage side. And that is the key part of the more, again, our constructive kind of view of the markets going into next year.
Yeah, so it doesn't just apply to valuations. Obviously,
Correct.
what we're talking about,
Yeah.
how the market should be valued, how a company should be priced. It's a direct correlation to how it affects the grassroots, the companies. For example, car dealerships or anyone who is sitting on a revolving line of credit. In other words, the interest rate adjusts daily to the current interest rates that the Fed is dictating. And if your price to maintain inventory and a floor plan at a grassroots car dealership is at a heightened level, you're just not going to have as much inventory. You're going to keep your inventory down because the cost to carry is so high. And then of course, with the longer term 10-year, not only does it a direct correlate to our valuations, but it also affects mortgages. And of course, I have offices in states that houses are starting to sit longer and more inventory is building up. And then, of course, the new home builders will pause on new developments. And if you think about all that goes into a new development and putting those refrigerators and stoves and dishwashers and all the things that a house maintains, those are things that could have a longer tailwind and effect. So there is a certain, to my audience, focus as it relates to not only the markets that we're plugged into, but also how it affects the next turn as it relates to your other assets. And so that's a very, very helpful, Bernard, feedback. And so what I'm hearing you say is, listen, you're very optimistic. You were the last time we met. All the days run together. You and I were talking about earlier. We met earlier this year, and I remember bringing you in right after the election, being what feels like a decade ago was just literally a year ago in November. And your feedback and your guidance has been dead on over the years. And so I've chosen to leverage your brain, your experience, because of the understanding of how this tariff and global markets and the U.S. dollar have pulled us together today relative to the depreciated dollar, the tariff situation. And so I'll summarize. Your feeling is that this situation with the U.S. dollar is something that had been elevated in value for quite some time. So maybe it needed to have some cooling off or cushioning to that value, but also the tariff sort of front loading of imports could have also played a bigger role there. So we could have some your view on the economy relative to earnings and valuations is extremely optimistic due to the fact that we're seeing double-digit returns and return on earnings year over year to the tune of 13% next year and the following year. And this year we're looking at 11.8. My question to you is, what is the reason, if you haven't said so already, maybe just reiterate, for the double-digit earnings? And I could reflect back to when I started in the business. We were happy to see 4 to 6% earnings growth for the S&P companies. And now we're sitting here with 11% and over 10% for 3 consecutive years and 2 more years of similar growth. Why?
Yeah.
What's the cause?
Look, great question. I mean, you and I have been doing these webinars for years now, and remember, just in the last couple of years, how many times have you heard a strategist say we're at peak margins? I mean, for years we've heard that. As, oh my God, we're at peak margins. We're going to go into a recession. Margins are going to peak. Revenues are peaking, and all that. The key driver is really technology, and it's why have companies been able to beat earnings estimates and maintained their margins, and in many cases actually even expanded their margins, it's really technology. And this AI revolution that started when, I first heard about OpenAI actually from my 21-year-old. He's saying, Dad, I'm using this beta site. It's called ChatGPT. Have you been using this? I mean, this has only been like 2.5 years ago. I don't know anybody, whether it's here in Wall Street, that are using it as part of their investment process, that isn't using some form of AI to drive productivity in their practice. And that goes through every sector. And Jeff, I've been managing money since the early 90s. And I remember when the World Wide Web came out, and I was a young analyst then for a major firm. We had 40 billion under management at a prominent bank. And I was sent out to how do we invest in the World Wide Web, because we were a large cap manager back then. And there weren't a lot of companies actually to invest in that were a good representation of that dot-com period, because a lot of the companies, as you remember, had no earnings, no revenues. They were just, a lot of them were fake. And then, the World Wide Web happened, and then you had all these new companies. Today, fast forward to the AI revolution, we're seeing concrete benefits of productivity and earnings growth across every sector. There isn't one sector, whether it's financials, fintech, that whole area, or payments, healthcare, drug discovery has been completely revolutionized and made more efficient because of AI. Even retail, e-commerce, all of those things, or advertising. Think about a company like Adobe. Adobe was the only game in town when it came to putting websites together for professionals. Now, any kid can put together, with AI, can create a website that is actually is really good, and so forth. So we've seen, because of technology, we've seen a maintenance and actually expansion of profit margins, which is extraordinary. And that's the secular growth story that we keep pounding the table on. That thing is just plowing through everything. So all the negatives we hear on things like tariffs and so forth, yeah, those are short-term problems. And look, the tariff, President Trump took a big risk to use tariffs as a sort of a blunt tool to reconfigure our terms of trade around the world. Most people wouldn't have done it that way, but he's done it that way. And he's an unconventional president, for sure, coming out of the business world. And it's going to change and improve our terms of trade here in the United States. But that's a short-term risk and reward scenario. The long-term secular growth that's really plowing through everything, especially in the US economy, and we're the leaders in that. China's number 2 is AI and technology. And that's the thing that makes it exciting for me to wake up every morning to find out, okay, a company like Rockwell Automation that we own, which is a 100-year-old company, they're using AI to manage and steer their robots, all the things they use for advanced manufacturing. And guess what? It creates more profits, because the more you shift to software and AI, it makes all these operations much more profitable. And for us as equity investors, that's a fantastic scenario.
Outstanding. You're the best, Bernard. I appreciate your ability to really zone in on what's happening, why it's happening, and really give us a foreshadow of what we should be considering. I'm going to take and separate into 2 questions that are both related to making and positioning your assets accordingly. One, what do you anticipate interest rates to do on the longer term for the next, if not couple months, 12 months? 2, what sectors do you like? I think you've mentioned international stocks, manufacturing, infrastructure, energy. You've also talked about technology and AI, which I'm going to also talk about after your prognosis and guidance. But if you can talk about both, what sectors you like, and as well where you think interest rates, and I'll attach it to how it affects us, please.
Yeah, no, absolutely. Look, technology, we're in the early innings of AI adoption. So there's there's, the Nvidias and the Broadcoms and all those things are still great investments. I mean, look, they've gone up a lot, but any core, at the core of any portfolio, you need to own these kind of semiconductor stocks. On the domestic side, that's the Nvidias and the Broadcoms. On the international side, is Taiwan Semiconductor, things like that. So look, that whole thing is in place. But near term, the big opportunities with this normalization of yield curves and better economic outlook is financials. So near term, we're very bullish on financials. I think you need to be overweight financials. And the other part of the technological transformation that we're seeing is industrials. So we're seeing a massive reshoring of manufacturing capacity in the US, and that's being driven by technology. So it's very interesting. Jensen Huang, who's the CEO of NVIDIA, he's not just going to banks and your typical customers to sell his capabilities on the AI side. He's going to old line industrial companies, and it's just amazing. Even companies like in the agricultural world, Deere. I mean, Deere used to be just selling dumb tractors I mean, they're great tractors, but now these tractors are self-driving. They're bundled with data subscription where there's basically, if you're a large scale a farm in the United States, you can't operate without this technology. And that's made a company like Deere much more profitable because they're not just selling tractors on the one side, they're also selling the software on a recurring revenue basis. So what happens to the multiple of a company like Deere? It's higher. You don't pay 12 times earnings for it anymore because it was selling equipment. You're now buying the same stock at 25 times earnings. And that's the technology effect that we've seen in the markets as well. Do the markets deserve a higher multiple? Yes, because a lot of the sectors across the board, from healthcare to financials to industrials, are being transformed because of technology. And look, does that create a problem for society down the road? Yes, because employment, I mean, it's going to displace people. And that's going to be the big challenge for our politicians and for our society is, what do you do with people who can't find jobs anymore? And that's a whole other topic we can go into, but from an investment point of view, certainly these technologies are creating massive opportunities, and it will also create new types of jobs. I mean, if you talk to your 20-year-old son or daughter today, all of that generation, they're using generative AI type or large language models, whether it's chat or Google. I mean, look, I'm somebody who likes to Google things, but you probably noticed your Google search has changed. When you put something into Google, the first thing you see is Gemini. It's AI. It's an AI-generated essay of what your question is, and then you see the typical Google searches. So even if you're an old guy like me, you're using a generative AI type technology on a daily basis, even if you're using Google. So it's a lot going on, but very exciting things going on.
Excellent. So technology, of course, for the long term. You talked about the infrastructure, the ripping of the guts out of the computer and putting in the new technology, semiconductors, domestic as well as international. Right. You talked about the financials, the yield curve you've talked about. We've had a situation where short-term rates have been higher than long-term rates for a very extended period of time, years. We've seen the global markets get that back in line where the short-term rates, which should be lower than the longer-term rates. Yeah. And now that lends itself to an economy that's expanding. And that's what we're seeing happen across the globe, including the United States, hopefully very soon with the short-term rate. And you're talking about what the benefactors are. And the financials would be the largest benefactor because guess what? They're taking in money, giving an interest rate, and then turning around and using that money to generate a higher interest rate, which creates margins, profitability. You talked about how companies are evolving and not just product driven. They're actually sales and recurring revenue. The old Gillette razors. You got to keep coming back and buying the replacement. Same thing now. Deere is filling that model, which creates valuation increase. You talked about the fact that we become more effective and efficient due to technological advancements, which makes productivity higher and cost of doing business lower, which returns double digits in earnings. And that's what's transpired in my career of 30 years. And what you're saying, I'm going to quote our late great Frank Sinatra, the best is yet to come. It's just getting going. So you're saying essentially all the benefactors in the process and the evolution of what's happening on the balance sheets for the different governments and the impact that that could have on the financial sector. You're also talking about the catalyst to expansion and the catalyst to a continued bull market, which is technology. And I'm going to remind everyone there's everywhere in between as well. You have the benefactors of the technology that are ultimately going to deliver higher earnings that we haven't talked about yet, between financials and technology. And so making sure you're diversified is a takeaway. I'm going to ask you one question, and then I'm going to summarize because we're coming upon my attention deficit. I'm going to lose you, as I imagine my audience might as well. We're all hearing a lot about this new crypto and the dollar under pressure. We talked about why the dollar's come down somewhat this year, more so than normal. One, the elevated valuation that was based on its 100% debt to GDP, compared to Germany's 60% debt to GDP, calls for a weaker dollar. We talked about the import increase front running the tariffs and how that import export affects the dollar. But it lends to the narrative as we have a tariff war going on, a war with no bullets, and companies taking shot, or I should say countries taking shot. No one's blind to what's being said across the pond in different parts, India, Russia, China. What's your take on the U.S. dollar and it's being the reserve currency, and what do you anticipate? I've asked you this before. I remember your answer. Let's see what your answer is today.
Yeah, I mean, look, the U.S. dollar is likely to weaken further. And if we kind of look at it in a historic context, so after the Second World War, so if we go into the 1950s, we were 40% plus of the world economy. So almost half of the world economy was dominated by our economy. So anything going on in the rest of the world was really important to us and how we operate our economy. Fast forward to today, we're only a quarter of the world economy. I mean, still a lot. We're still the biggest economy in the world. I mean, the Chinese are catching up quickly, but 25%, we've gone from 40% to 25%. So if you think about that, we are looking more inward now in terms of our terms of trade and recalibrating our terms of trade versus the rest of the world. Because, you know, for us to take the cost of bearing the brunt of the world economic system is not that much in our interest anymore if at 25% versus 40%. So a lot of that, I mean, it used to be you'd get scolded for talking a weak dollar, but what has happened here is we've reconfigured the terms of trade, our relationships, our trade relationships with the rest of the world in a way where there's a more equitable, some would say more fair distribution of responsibilities and opportunities in the world when it comes to trade. And we're doing that through tariffs. I mean, which is a more complicated way of doing it. But look at our trade with the European Union now. So any goods being imported from the European Union have a 15% tariff on it. Okay, so if you're buying a Mercedes or that's produced in Germany or buying a fancy wine from Bordeaux, it's going to have a 15% tariff on it. So the question is, how does that affect our trade? Well, it's going to accelerate trade in the United States, and that lower dollar gives us the opportunity to accelerate our domestic economy, which is very important also for us in the global context. So, interest rates are coming down. Typically, if interest rates are coming down in a country, that also puts pressure on the dollar. But I think that's just a rebalancing of the world order. So, I mean, I would not be betting that the dollar would be strengthening here because certainly the interest rates are coming down. But we're about at a level here now, which is probably where we're going to be operating from. And it's interesting if you look at companies are large companies that do business abroad, they're seeing a tailwind in the currency translations for the business they're doing abroad. So if you look at big technology companies like Microsoft, half of their revenues are actually abroad. So with the weakening dollar, it actually gives them also a tailwind. And actually, if you look at the S&P 500, something like 40% or 30 to 40% of the revenues are also from abroad. So that's also giving you a bit of a tailwind. So all of these things, you know, I don't worry about the strength of the dollar here. I look at companies from a bottom-up point of view, and our global companies are doing better as a result, and our exporters, who are manufacturing companies, industrial companies, look at the Rockwell Automations and things like that, Parker Hannifin, another great American company that is really going to benefit from that lower dollar when they're selling abroad.
So there's always benefits and disadvantages to either scenario, and the dollar weakening will make it more opportunistic for companies outside of our country buying our products because they can buy it with a stronger currency.
Capital flows, Jeff. I mean, just a quick comment on capital flows. I mean, the big worry if the dollar weakens too much and there is no confidence in the dollar is that capital flows could basically leave capital that has always been investing in our very innovative and growing economy would go elsewhere. That's a worry. But look, given the technology revolution that we're seeing play out in the United States with AI, I'm not worried about that. So, you know, just a comment.
We're not at a crossroads of major concern. It's a factor that plays into the pure math of what we're producing and consuming relative to history, and of course other factors that have played into the dollar being stronger than it should have. But the benefits of what's happening relative to the weaker dollar are also relevant. That'll create some opportunity in areas that weren't prior. Like, for example, folks, if you remember back to 08 and 09, there was a number of investors coming from outside of our country with our dollar being weaker and buying up things like land and houses as an example. And the same thing applies to companies. With 40% of all the products being manufactured here in the United States in the technological sector, those 40% are getting sold overseas, and it's more motivating for those call them international companies to purchase our product at a discount. So there's going to be benefits to the bigger picture, and I think ultimately what you're saying is that you're not concerned about the dollar being replaced as the, call it, backbone of trade across the universe of business. And so, and that's what you said, by the way, 3-4 years ago. Back when I think Biden became president. So you're consistent there. I'm going to tie it together if it's okay. First of all, you have short-term impacts to the market. The market has gotten a little bit higher by its valuation multiples, as well as it hitting new highs. And what I've learned in 3 decades is short-term, you're going to have volatility. Matter of fact, once a year, the market will pull back around 10%. Once every other year, the market will test a 20% downward, call it sell-off. And every quarter, the market will go down 3 to 5% at least once. With that data, why would anyone buy stocks? Well, the market over the last 25 years has averaged over 11% amongst those pullbacks. So what do we learn? We do not react. We don't allow fear, and we don't allow greed. You watch the news that's on to my left here, you're going to jump or you're going to get too aggressive listening to the narrative. And believe me, if they didn't take that approach, we wouldn't watch. So of course, that's their motivation. Do not get caught up. That's our job, is to keep you focused in your guardrail. The market will be going higher because of valuations and earnings, double-digit earnings, as we've seen the market, the S&P 500 outlook and companies provide us in the next 2 years. We also know that companies have beat their mark over 80% of the time this last quarter, and on average 79%. So what they're telling us they're going to do, they've delivered better historically. So long-term, we see upside, diversification. If you start chasing, and this is something called the periodic table of asset class, if you start chasing what had just done well, every year you're going to miss out on what maybe didn't do well in previous years that will recover. Diversification. International stocks have underperformed domestic stocks since 2017, and then all at once, international stocks have tightened up the gap for different reasons. So you not put all your eggs in one basket, you diversify. Furthermore, we want to make sure that we understand the amount of liquidity we have that can offset unforeseen expenditures. Do you know that 97% of Americans get a $1,000 unforeseen bill, they go into debt. What we want to do is change that trend, adjust habits, make sure we have enough liquidity for the monies we need for the next several months to the next several years, and make sure the money we know we do not need for 5 years or longer is put to investments and strategies that are going to combat inflation, right? So we want to make sure we have a nice balance to protection and opportunistic, and we take emotion out. We dollar cost average. What does that mean? We continue to put our discretionary income, what's left over after our expenses, into longer term investments inside of our retirement accounts, like our 401ks, as well as our taxable accounts for after we put our maximum away. Continue to save your discretionary assets and income and do not get emotional, right? And I believe I can tell you this with a strong degree of certainty, even before this conversation. I've been doing this 3 decades, and I will tell you that I'm more cautious but optimistic about this economy and this market in the next several years than I have been in my entire career. 3 reasons. 1, we have monetary policy and regulation aligned to business activity, which means liquidity in the system and red tape getting peeled back so businesses can move forward. Clarity on the big, beautiful bill, understanding that we have cash on the balance sheets that we were not expecting due to depreciation and write-offs that we can now use for business activity, and we understand what the laws are definitively. Tariffs, we're getting more clarity every day, so we can see 35 countries have signed and agreed to a trade agreement, with a few out there that we know very well holding out that we'll get more clarity on. Knowing the players on the field and how we can navigate is powerful, and right now we have more clarity. As you pointed out, third, and probably equally as important as monetary policy and regulation, is AI. We went from 4 to 6% return on capital for corporations to the next 2 years projected at 13%. That is due to technological advancement, AI, ChatGPT, and all the buzzwords we haven't even heard yet, because I can assure you there's going to be conversations like your 21-year-old son introduced you to 2 years ago when no one even knew what ChatGPT was. It is going to revolutionize how we operate, visualize a world with more bots than humans, and these jobs that are going to be created that we haven't even thought of from that new technology. Stay the course. Don't get emotional. Make sure you maintain a level of reserve capital to overcome the unforeseen 08, and stay the course. The eighth, call it wonder of the world by Albert Einstein, was the power of compounding. By having $1 million invested, growing at an average rate of 10%, in 20 years, that $1 million will be worth $4 million. The power of compounding and letting your long-term money work for you and not get caught up in the short-term trend. Because I expect the market to pull back and actually welcome it, because we're dollar cost averaging, and a market that goes straight up that I witnessed in the late 90s is not healthy. So be prepared, be unemotional, and we're here at Fratarcangeli Wealth Management with leveraging folks like the sharp minds of Bernard Koepp, coming from different areas of expertise and experience, to guide, counsel, and protect you through these environments and make sure your family, your legacy, and your short-term objectives are met with the ease of execution that I think we can bring to the table. I thank you all, and I'll see you soon. Thank you, Bernard.
Thank you, Jeff.